Welcome to Theo Trade. This is Don Kaufman doing the weekend update here, May 22nd, 2020. We still have a few minutes to go to the cash close in this Friday session of trade. Nevertheless, we're coming into a holiday weekend. Things are kind of dying down in terms of volume. Listen, let's get to work. The market in what appears to be an extraordinarily volatile holding pattern. We're going to explain much more in depth why we're not just calling this a volatility box anymore, but the entire marketplace in this kind of holding pattern. Again, let's get right down to it. We're going to start with what we term the edge of normal. So rather than dig into, this Friday's trade, which has been massively unchanged, the S&Ps are kind of drifting a little bit higher, we're going to start and look at the bigger picture in this marketplace. The first thing that I want to kind of detail is, again, what I term the edge of normal. So this past week of trade, right, the expected move in the SPX, the mother of all option products, is right around $94. That means you're looking for a $94 move higher or a $94 move lower. In all throughout the course of the week, I mean, literally on Monday, we just shot right to the edge of the expected move. And that line, and again, these two lines, this is where the week started, right in the middle here. This line up top just represents approximately a $94 move to the upside. We shoot to the upside of the expected move, but people, we're holding it together. The expected move is right around 29.57. That's something that we've actually been talking about on some of the nightly videos. I actually talked about it on Monday. I talked about it on Wednesday. Corey Rosenblum talked a little bit about Thursday. And here we are on Friday because it's of critical importance. Again, the market, it's holding it together right now. What this amounts to is that hedging activity is once again, it's starting to drive the marketplace. Now, for those of you, you're like, I'm not exactly sure what that entails. Okay. The trading firms, once again, are getting a grip on reality and they're moving markets with hedging activity, which is starting to normalize the marketplace to a larger degree. But before you go any further into the idea of normal, and this is exactly why I wanted to bring this up, because we're talking about the edge of normal, and right, you're just riding on the edge of the expected move, and you're kind of thinking things kind of feel normal. As much as I want to say things are normalizing, at the exact same time, I cannot help, and we're going to deviate for a second here. We're going off the path. I can't help but to look at the S&P futures. Okay, and I'm even going to include some overnight trade here. These S&P futures, they moved overnight to right now. Roughly it's 50 points. I mean, that's a 50-point move. Now, remember something. That's a 50-point move in what? A couple hours of trade? But the entire week is looking for plus or minus approximately $94. But when you're getting, one-day movement in accordance to what? A $50, move. Again, these two, something is still definitively wrong. And I'm going to talk a little bit more about that. But I wanted to bring your attention right up front, because this is the kind of thing we're like, well, what can I do with that? Intraday moves right now are rather spectacular versus what the volatility is dictating they're supposed to be, for the week. What I'm actually really getting at is like the S&P volatility is still, it has not normalized by any stretch of the imagination. Yes, we are in fact adhering to the expected move. In fact, that was kind of a cool chart that I just brought up. This is the upper edge of the expected move. And when I snap it to a 1-minute chart, do you think hedging activity right now is really driving this thing? I mean, this is a line that we drew on a chart last Friday. And here we are throughout the course of the last two trading sessions, literally just jumping right around. And again, that level happens to be the 29.57 57. So it is absolutely what we term the edge, if you will, of normal. So the SPX feels like it's normalized, but the intraday moves are nothing less than phenomenal. For those of you that speak a little bit of option geek, this actually lends itself to strategies like gamma scalping on an intraday basis, where you can literally go out there and scalp long and short stock against a long straddle, because the implied volatility of the options, okay, is lower, pretty meager versus some of the actual movement that you're seeing on a day-to-day basis. All right, enough of that. I don't want to geek out too hard on you right now. So the SPX, once again, resides inside of the expected move. On the edge of normal, we were expecting a $94 move, and quite ironically, it looks like you're going to get people almost every ounce of that $94 move. We close here in just about 7 minutes. Now, what kind of an expected move do we have for this next week of trade? One of the things that's obviously going to play into this substantially is that we're coming into a holiday week of trade. Yeah, it's still a week out there, okay? But the expected move right now, you're looking at about $73, but it's not settled. One of the things that I try to do is right at the end of this trading session, that's the expected move that I would use, okay, for the next week out. So if this said $73, I would actually extend the three lines approximately $73 higher, $73 lower. That would, of course, give us our expected move. All right, now, this is where things get a little bit more interesting. So the volatility box and sector rotations. Okay, the volatility box is still very much in play. Initially, I'm going to jump to the spiders, okay, to kind of give you a feel of this volatility box. It's something we've been talking about, I mean, ad nauseum now for almost the past 6 weeks. What you're looking at is a range inside of the S&Ps, and we call it the volatility box. And first of all, that's just something I've kind of dubbed these moves, you know, over a long period of time. Call it the volatility box. Sometimes you call it the hurt locker. You really can get drawn into these, and it's actually one of the reasons I call it the hurt locker. When I say you get drawn into them, all I'm saying is, okay, we're in a holding pattern right now. But what cannot be stressed enough is how dangerous, all right, this becomes. Every day that we are in, okay, this box, it's that much more risk that just continues to accumulate. I mean, lately, on a day-to-day basis, you're like, wait, what risk? Well, on a day-to-day basis, we see about 26 million option contracts trade. Now imagine, okay, umpteen trading days and 26 million contracts. You know what? Okay, all of the open interest in this marketplace, okay, is right inside of a very, very tight range. And it's one of the reasons that I keep reiterating, you know, about the volatility box, because you are so likely to just step out here, okay, to want to take a whole lot of risk, okay? And it doesn't matter at this point if you're bullish and we break to the upside, you're like, I'm a hero, until we crash back down. If we break to the downside, you're short, you're like, this is wonderful, till we explode back up. The amount of open interest that is accumulating inside of this volatility box, it's just downright terrifying at this point, because when we make the move, and this is the point where everybody's sitting here, they're like, this doesn't even make sense, man. There's the jobs number. Even the Fed is bearish. I mean, this week there was even more bearish news that came out, and it doesn't matter. The market's detached, and that's okay. Okay, it really is. Let it get detached. I mean, we've seen some crazy detachments before, but right now, what's going on Main Street hasn't actually settled in on Wall Street. And again, it's okay. What you got to focus on now is, listen, what do you know? You know that we're in an incredibly tight range, okay? You know that the range, though, is not just being seen in the spiders. And that's one of the other points that I want to make, because this is something, quite frankly, that I have not seen before. And I wanted to tell you that because, you know, I'm thinking to myself the other day, I'm looking back and I'm like, oh, there's another volatility box. In fact, here, I'd love to detail, you know, this is a wild volatility box in late 2018 that broke to the downside. And I was showing that. Here's another volatility box, and we can actually go back into this one. We can go time and again and show you really wild vol boxes that end, okay, in just wicked moves. By the way, this one broke to the upside and fell flat on its face, then broke to the upside again. Heavy open interest. Yeah, it'll do that from time to time. Nevertheless, one of the things that we've never seen before, okay, is that this volatility box correlates to so much more. And that's why I'm actually going to bring up a comparison chart in this particular case. And hopefully this does this some degree of justice. What you are looking at here, okay, there are our lovely spiders inside of a volatility box. And this is none other than it's the bonds. So that is SPY bonds compared to one another. Now, it doesn't necessarily mean, by the way, this doesn't dictate necessarily that, if the S&Ps are down, the bonds have to be up. All I want to show you is we're accumulating heavy risk inside of the spiders. We're accumulating heavy risk inside of the bond market. We're not done yet. Okay, what other comparison would you like to do? And we can come in here, we can go to studies, we could turn around to go add studies and compare with, right? What do you want to compare it with? Think about other major products. One of them onto which we've been watching here happens to be gold. Now, I'm actually going to tack gold in there as well. So things are getting a little crazier on the chart over here. It's okay. Listen, you got bonds. Now you got gold. What do you think gold is doing? Same volatility box. Nah, I'm just kind of sketching it in over there. All right. But you're like gold's not that big of a marketplace. Like, I get it. Yeah. How about we actually throw the dollar in there? Okay, because I think that's fair game. And one of the first things I want to do before I throw the dollar onto the comparison chart, I just want to show you the dollar because it exemplifies, if you will, this kind of volatility box that we are in right now better than almost any other product. Okay, listen, I don't need to go back to the comparison charts over here. I think people get it, right? All the products have correlated to one of the tightest, okay, ranges yet in a volatile market that we've seen. Now, I'm going to come back to some of those thoughts here, okay, a little bit later. The next thing you also have to kind of recognize is along with some of these volatility box, and there's several of them, obviously, in the dollar and gold, in these spiders, okay, it's, again, bonds, it's crazy. Then we look at something like the QQQ, and this is where everybody points, well, this is the odd product out. It's not all that odd. So the QQQ is heading straight up in the midst of all of this, okay? But at the exact same time, we've got some really big sectors, okay, that are just utterly flat. One of them happens to be none other than the XLF, okay? The other one is the XLE, which is the energy sector. Again, we're constantly, there's the closing bell today, okay? We're constantly picking on, if you will, almost detailing, all right, the same sectors again and again because we're seeing these rotations, okay? There's the financials. Listen, the S&Ps, they're not going to progress to the upside without the help of the financials. Now, if you look at the S&Ps, you're like, well, they are kind of, well, they're not going up. All we're basically doing is boxed in, right? We're channeled in. So you have the NASDAQ that's completely deviated, if you will, from the major index products. But at the exact same time, as we're going to talk about in a minute, big tech, once again, I asked that question last week, is big tech on the ropes, right? Which we absolutely believe it is. It's spurted even higher. It's just downright frothy at this point. But I'll come back to that thought here in just a minute. Again, one of the things that you have to think about as a trader, okay, that it's not about just what's going up or down. Because I'll tell you right now, I'm short some of the NASDAQ, and I'm dead wrong in here. And at the same time, though, okay, I'm able to sustain a little bit of the hit that I'm taking in some of those products because I'm using, okay, some of the right hedges. There's one, reality here. If the S&P, and I'll put this as the SPX, if the SPX is to go up, it's got to be done on the back of this product right here. So I'll tell you right now, if you are worried about the marketplace rallying, if you're worried about the SPX taking off to the upside because you're short, put on, okay, some type of back spread, volatility back spreads right here in the XLF. Because if we pop to the upside, the XLF is going to save your bacon when the SPX goes up, right? Do it in the financials. They haven't moved higher, Okay, they're still down, again, on a percentage basis. Well, need I even mention it? Well, sure. Why not? Let's actually bring it up over here. Year-to-date percentage, they're down 30%. If you compared that to the spiders are down about 9%. And lo and behold, the Qs are actually up on the year about 6.25%. So again, if the S&Ps are to make that move higher, they got to do it on the back of those financials. What would also have to kick into high gear? Into high gear, well, you'd have to see the emerging markets explode to the upside for the S&Ps to continue higher. You would also have to actually see the energy sector even play a role. Now, the energy sector to a lesser degree, because it has diverged quite substantially. But what is so important about this conversation here, sector rotations are critical, because this is no longer a marketplace about let's go higher, let's go lower. I mean, come on. You got 5 stocks that are actually driving, if you will, a lot of the upward momentum inside of the marketplace. But net, the S&Ps aren't really progressing higher. Obviously, sectors like the XLE, which is energy and the financials, okay, and the emerging markets, none of those are progressing higher. You know, I can also make a pretty good argument for the XLP, which is actually waning a little bit, right? By the way, the XLP, that's your consumer staples, okay? We can go on all day long with sectors that are not appreciating, okay? They're not going up. So there's plenty of area here, all right, if you will, to get a hedge on if you thought those S&Ps were going to pop to the upside. Now, let's get down to some of the big tech, all right? So the object of my affection right now is none other than what we term the monsters of tech. Now, the monsters of tech is a conglomerate symbol. It's a Facebook, it's an Apple, it's a Microsoft, it's Google, it's an Amazon. Accumulated together, it's up 13.5%, okay? But, as I was saying, you know, big tech, getting a little bit frothy out there. What does frothy even mean? All right? I don't know. That looks a little frothy to me. One of the things I first wanted to point out before I went any further into this, okay, and I had Microsoft listed last, but I wanted to show you Microsoft because, you know, I like to look at everything in terms of much more a statistical point of view. I don't care about any MACD, any Fibonacci. It's a 618. Please, I got your 618 right here. Listen, what I wanted to show you in Microsoft, this is where the week started. This is where the week ended. Okay, Microsoft did not appreciate like everything else to the upside. Everything else hit the upper edge of the expected move. All right, so Microsoft, what did it do? Absolutely nothing. That's why I said big tech looks a little frothy, but I'm not done yet. Then we can bring up Apple. Now, Apple, what did it do? Right to the edge of the expected move. I mean, pretty much closed on the edge of the expected move. All right, you got me there. That one was bullish. Facebook. Oh, the week belongs to Facebook. Now, I make no two ways about this. I am still in a short position inside of Facebook. Ooh, the pain, the agony. Listen, I got them right where I want them. My short position inside of Facebook is a much longer duration take. For those of you that don't remember, okay, I was in a not such a dissimilar position in another stock. And I was in that position for a long time, and it was a stock called Boeing. And that one paid out, okay, inside of Facebook. Hey, a little bit of pain is going to be necessary to see this one come to fruition. Nevertheless, okay, I remain in the position. So Facebook explodes to the upside. But time out for a second. Why am I showing you Facebook if I'm calling Facebook a little bit frothy? I'll tell you exactly why. The volatility skew in Facebook, it flipped over. And you're like, what does that even mean? Okay, well, let's go take a quick glance and go over here, go to implied volatility. Open up a bunch of strikes. Let's get crazy. Open up like 50 strikes inside of Facebook. And what I wanted to show you is take a look at the at-the-money implied volatility is about 33.8%. Okay. Drops off mildly, and then guess what? As you go further out of the money, the volatility picks back up. The vol skew is actually inverting here, which is a very definitive sign of froth, if you will. That's where I actually came up with that term, a little bit frothy. Okay, the term frothy is not mine, but relating it to implied volatility, I'm taking that one. All right, it's mine. So the volatility skew kind of flipped over in there, and I would watch Facebook very carefully at this point in time. By the way, people constantly ask, like, why is Facebook the object of my affection to the short side? Okay, quite frankly, it's about risk reward, right? I look at the upside potential versus some of the downside risk, And then people are like, why do you gotta hate on Facebook? It's not about hating on Facebook. It's about risk reward. The other aspect, and I do like this, if you want to get into the fundamentals of it, into the fundamental, aspect, Facebook is all about advertising. And every company in the S&P 500 right now is talking about clipping a huge amount of their advertising budget. I mean, Google weeks ago said their advertising budget was going to be 50% of norm. And then you start to think about this, you're like, oh, I kind of see what you're saying. That's a fundamental perspective. That's not the reasoning, though, behind the short position inside of Facebook. So we looked at Facebook where the skew flipped. We look at Microsoft, which was basically flat on the week. Why Amazon? Okay. Well, Amazon, this, for those of you that are market technicians, looks like a wicked key reversal in here. That's not exactly my cup of tea, but it'll do it if you're looking for the wicked reversal. Watch this in this next week of trade. Again, we've been throwing off signs week in and week out that, big tech, it's ready to roll, baby. Oh, it's going to happen. Okay. It's going to happen, but it's not going to happen. Okay, until the bonds let it happen. And that's where one of the reasons, the next point on here, Bond Watch 2020. Okay, why week in and week out am I also bringing up the bonds? Critical importance, the bond volume starting to come back. What's actually kind of cool about this, today is Friday, and the bonds actually closed early today, and yet they still did some heavy volume. The volume is really, really starting to come back. And I believe, okay, if the bonds break this range, first of all, if the bonds break the range, the S&Ps are going to crack their range. But the bonds breaking the range would be the definitive sign, all right, of we're out of that box and things are going to get wild. But, okay, you need to be very, very cautious with this because the bonds, quite frankly, could break in either direction and cause the marketplace pain, okay, to either side. And that is a highly convoluted conversation that I'm going to have a bit next week here at TheoTrade is our thoughts about interest rates and also the possibility of interest rate targeting. Bottom line, okay, in the next week, 2 weeks of trade, just don't get lulled to sleep. What you're seeing inside of the SPX, okay, and by the way, talk about close to the expected move, right? That bell went off 9 minutes ago. Where did we end up? We're on it, baby. We're less, and it's just shocking to see this stuff, okay? You can't make this up. I'm obviously, recording this seconds after the market's closed, okay? You're on the expected move of 29.57, actual close 29.55.45. Shockingly close. You have a $3,000 product that missed a line on a screen by $1.50. And that's why we pay so much attention to that. As I was saying, do not get lulled to sleep. Okay? Yeah, we might be in this little volatility channel. Yeah, it's been mellowed out the last couple of weeks. Okay, but it hasn't. This is not a quiet marketplace, right? Volatility is very much alive. You get lulled to complacency. You shouldn't be lulled into anything, okay, in a 28 VIX. Again, I'm not a big advocate, if you will, of looking at the VIX. But if you look back at the last 5 years, if you looked back even at the last, 20 years in the VIX, and I think that this is a good representation. I'm literally pulling up 20 years of the VIX because I want to show you precisely where we are. Okay, there are not, over 20 years, okay, of volatility, there are not too many instances, people, where we actually stay up here. This is not a lovely place. And it's one of the things that if I don't remind you of this day in and almost day out, the market's going to remind you of this day in and day out. You got to go back into '08 to see time like this where the volatility stayed in that 30 range. You got to come back into, the times where the internet bubble was literally crashing down to see volatility sustained like this, right? I cannot reiterate enough. Volatility is very much alive. It's not a quiet marketplace. Hey, you don't have to listen to me. Listen to the VVIX. That's the volatility of the volatility index. Never in the history, okay, in this VVIX has it been sustained anywhere near this level. The other, okay, kind of warning shot across the bow continues to be the volatility futures, which if you looked at this, you know, the novice would look at this and think that volatility futures have normalized until you start looking further out in time. And again, I'm going to highlight this for you because it's such a critical, you know, kind of juncture in the marketplace. The 26-day volatility futures dropped out to 30-30. Then you go a little bit further in time to 61 days out. And you're like, okay, that's normal, right? The 61 days are slightly above the 26 days, so things have normalized. But then you go further out in time and the structure again drops back off and you're like, oh, okay, do not again get lulled to sleep. Keep your position size small, okay? You know, that means you're trading contracts, futures, keep them small. You're trading options, keep it small. Keep yourself in most respects, if you're holding positions overnight, keep yourself defined risk, okay? Keep your head down, and I'm telling you right now, do not keep pushing more and more capital to one direction or the other. What I'm saying is don't get all bullish, don't get all bearish, okay? Pick and choose entries until we break this volatility box. You're on notice. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful holiday weekend. Bye-bye.